This is Amar. He is the Chief Financial Officer of Corporation ABC. One day, Corporation ABC needs funds to cover operational costs. Amar is stressing out. Then he suddenly remembers that his team have already discussed about repurchase agreement.
What do you guys think about repurchase agreements and how it's work?
Okay, so a repurchase agreement is a short-term borrowing arrangement where one party sells securities to another with an agreement to repurchase them at a later date for a higher price. The difference in price represents the interest paid on the loan. Repos are used to raise short-term capital and manage liquidity. Repurchase agreements or repos are short-term financial transactions where a bank sells a financial instrument to a third party with an agreement to repurchase it at a higher price on a specific later date. This setup functions like a collateralized loan, providing immediate liquidity to the seller, usually a bank, and a return to the buyer, usually an institutional investor, through the price difference. Repos, typically collateralized with high-grade financial instruments like Malaysian government securities, are used by businesses, governments, and financial institutions for effective short-term liquidity management. Their collateralized nature adds a layer of protection for lenders, making repos a low-risk and reliable option in the money market.
So, who is the market players for the instrument?
The repurchase agreement repo market in Malaysia is a key component of the financial system, providing liquidity management and short-term funding. Key players include Bank Negara Malaysia (BNM), which regulates and supervises the market, commercial banks like Maybank and CIMB, investment banks such as CIMB Investment Bank and Investment Bank, and Islamic banks using Sharia-compliant repo. Statutory entities like Khazanah Nasional and EPF, insurance firms like Great Eastern Life Assurance, and money market funds also participate. Broker dealers facilitate transactions, while corporations and foreign institutions, including HSBC Malaysia, use repos for liquidity and asset management. Together, these diverse participants enhance the market's efficiency, liquidity, and depth, ensuring its crucial role in the financial system.
They share their knowledge and thought about the repurchase agreement. For your information, repurchase agreements repos have 5 features. First, they are used for the short-term financing, often overnight but can extend for a few days or weeks, making them essential for managing liquidity and financing needs in financial markets. Second, repos are collateralized transactions where the seller provides securities as collateral to the buyer, reducing the buyer's risk by safeguarding against the seller's default. Third, the repurchase agreement specifies the sale and repurchase prices of the securities, with the difference representing the interest cost known as the repo rate, which is typically lower than unsecured borrowing rate due to the collateralization. Fourth, repos are governed by standardized legal agreements like the Global Master Repurchase Agreement (GMRA), outlining terms, obligation, default provision, and collateral handling procedures. Finally, repos serve various market participants. Financial institutions use them for the liquidity management, central bank for monetary policy implementation, corporation for cash management by investing surplus cash in the short term, low-risk instrument, and hedge funds for leveraging position and exploiting average opportunities.
Okay, so next, issuing repurchase agreements offers several benefits, including effective liquidity management by allowing institutions to quickly access cash without selling long-term assets. They typically have lower borrowing costs compared to unsecured loan due to being secured, which reduces lender risk. Additionally, repos provide robust risk management by using high-quality collateral that minimize credit risk. So their flexibility in terms of maturity and structure, along with their high liquidity and quick settlement, enables efficient cash flow management and swift response to market changes.
Let me tell you about benefit of investing the instrument which is making them attractive for various investors. Firstly, repos are low risk because they are short-term and usually backed by high-quality securities like government bonds, reducing the risk of the other parties not fulfilling their part of the deal. Secondly, repos are highly liquid, meaning investors can quickly access their funds, making them ideal for managing cash flow needs. Thirdly, despite being low risk, repos often provide better returns than other short-term options like saving account and treasury bill, offering competitive interest rate. Lastly, repos are flexible, allowing investors to choose the duration that suit their needs, and the term can be custom to meet the specific requirement of both parties.
Amar finally decided to go to the bank XYZ to sell corporate ABC's municipal bonds worth 2 million ringgit. They made an agreement that corporate ABC will repurchase the municipal bonds from Bank XYZ with interest after 7 days.
Purpose and benefits. For Corporation ABC, which is the borrower, it obtains short-term funds to meet immediate cash flow needs or to finance specific projects. For Bank XYZ, which is the lender, it earns interest on the loan while holding municipal bonds as collateral, which are generally low-risk securities. There are 3 risks and considerations, which is the first one is credit risk, the risk that Corporation ABC may default on the repurchase agreement. The second one is market risk. If the market value of the municipal bonds declines significantly, Bank XYZ may face losses if Corporation ABC defaults. Then the third one is interest rate risk. Changes in interest rates can affect the cost of the repo for both parties.